Good morning. Welcome back to the Retirement Report. I'm Hank Parrott, your host. All right, I'm going to be sharing some things with you one of them that I'm really looking forward to getting to here is called 18 Scary Retirement Statistics. I'm going to run through those briefly and talk about them, how they work, some things that you see if they resonate with you, if these are things that you're concerned about as well. These are all surveys that have been done that are, and what we're seeing is those surveys, these are some of the biggest concerns they have, and how you can, we're going to talk about some strategies again to protect against these kind of risks. First off, a couple of other things I wanted to tap on real quick. First off, I mentioned Federal Reserve raising interest rates. What impact is that going to have? It's one of the big unknowns that we have out there. Second, we talked about earnings in the S&P 500 index, and with the implementation of generally accepted accounting principles, GAAP, what might that do with regard to the reporting of those earnings? May we see a big drop in earnings as far as what the companies actually have compared to what we think they have, and what impact might that have on the stock market? Here's some others. A euro banking crisis being led by poor financials is one of the largest banks in the world. We're talking Deutsche Bank, for instance. That bank problems with Deutsche Bank could in fact have a serious effect on the German economy, and therefore Germany being the engine that drives the European economy, what impact that could have in Europe. The Chinese real estate bubble. Here's another one. We've talked about this before. Now, this is an interesting fact to me. They have built 71, are you ready for this? 71 1-million person cities in the last 6 years in China with no people living in them. Okay, so they're spurring the growth, but they're building like ghost cities. They have sold many of these apartments in these cities to their own people as investments. So what's going to happen if this all disintegrates, or when it disintegrates? China is a $10 trillion economy that has $40 trillion in debt. Okay, so these are some things when you look at what and this is the other part, when you look at debt and earnings, this is one of the areas, or GDP, this is one of the areas. Another is to look at, like here in the United States, at our tax revenue. When we look at the deficits and the debt that we have, which is now quickly approaching $20 trillion in debt, and what that might mean. I mean, if you took those numbers, for instance, and you put them into perspective, here's something to think about. Tax revenue, we've got, and the reason again for this is just like how you invest, how you think in terms of taxes for the future, and how that might affect your taxes and your earnings, and what kind of rate of return you need to make on your money. We know about inflation, right? So if I need to make enough money on my money to stay ahead of inflation to protect my purchasing power, another factor there is taxes. What am I going to be paying? What's my tax rate going to be? Because that's going to affect those earnings, right? Are going to be taxable. If they're in IRAs and that, when I start taking that money out, they're going to be fully taxable. What impact might that have, and what are some strategies I can implement both today and in the future to help minimize that? So here's something to consider. If we take the tax revenue that's being collected, which is about, well, in the trillions of dollars, $3 trillion, and we say, now let's just take out 8 zeros and act like it's our household budget, and we're bringing $36,000 a year in. We're paying out we're taking in $32,000. Okay, we make $32,000 a year, but we spend $36,000 a year. In other words, we're spending about $4,000 to $5,000 more per year than we take in, and we keep adding that to our credit card. Okay, we just keep running up the credit card. $400 or $500 a month added to the credit card. What's that going to do over time? Well, let's look at what is our credit card balance right now when we look at the debt, right? If again I take off 8 zeros to make this a little more something we can get our heads around, that would be like having approximately $200,000 or $199,500 on our credit card limit. Okay, our debt rather is $199,000 on our credit card, and we're adding about $5,000 to that every year because we're not taking in as much, we're not making as much as we're spending. Okay, you can see this is not going to end well, right? And this is one of the problems with the country and with the economy, and how they're going to fix this when we start talking about these Federal Reserve things. All right, I'm going to get into the 18 scary retirement statistics. Before I do, I'm going to make available, if you'd like to see how this works in planning, if you'd like to see how to have a full-blown comprehensive financial plan that deals with all the things I talk about, includes an investment analysis, includes the Social Security strategies, tax strategies, ways to minimize taxes in retirement, how to take money out of an IRA and minimizing taxes, in some instances eliminating them altogether. These are some of the things I cover when I do planning with clients. So for the first 10 callers to my office this morning at 615-376-5325, I will do for you a full comprehensive financial plan. Okay, so it's not just going to be a consultation where we sit around and drink coffee and talk for an hour. You're welcome to bring all your questions and anything you might like to personal concerns to me, and I'm happy to help you with those. But I also want to do a full plan for you. So what means Debbie's standing by. She'll take your information. She'll send out a checklist of things to bring to the appointment with me, and I'll do up a full plan. We'll look at what you have for income, what you have for expenses, what your assets are, what your liabilities are. I'll be able to do projections and show you your financial future, show you if you keep doing the things, if you save at the rate you're saving, if based on the money you've got invested in, and what kind of earnings and risk are there. I can show you basically what that's going to look like 10 years, 15, 20 years, and further down the line, and then show you strategies and ways that you can improve upon that, help you get the returns you need, as well as make sure you never run out of money during your life. So if you'd like to take advantage of that, again, first 10 callers, 615-376-5325. When you come in, I'll also give you a copy of my book, 7 Steps to Financial Freedom in Retirement. These are in that book, in my book, I share with you basically what I've, over the last close to 30 years now, how I've worked with clients, some of the stories there with those clients and the success stories that we've had, the kinds of things that we've run into. All right, so what I'm going to do is take a quick call, and then we'll get into 18 scary retirement statistics. First, let's talk to Evelyn. Welcome to the Retirement Report.
Good morning. How are you doing today?
Very good. How are you today?
Oh, I'm just trying to stay out of the snow and keep warm.
Good plan. How can I help this morning?
Okay. I try to do a lot of research lately since I am in that age bracket where I need to think about the future. Mm-hmm. And recently I came across an article on options, and it sounded really good because they framed it like, if you invest $25,000, you could get $2,500 per month towards your, income or your retirement. So how does that work? And is that something safe? And the second question is, how much money does one need to start a good investment plan?
Right. Well, any amount starts. Okay, so you can get started with let's say an index fund from Vanguard, a no-load fund from Vanguard, very inexpensively. $25 or $50 a month as an example would be, I think $25 even a month. They'll start you up a plan. You can, and here's the way to start. First off, you think in terms of some basics. Whatever your expenses are, you want to be able to save up, starting out at about $1,000 and then get up to about 6 times whatever those monthly expenses. So if it costs you $4,000 or $3,000 or whatever the number is, times 6. So let's say $4,000 a month, and you need about $24,000 or $25,000 set aside as an emergency fund. So that's one of the ways that you start as well. Now, if you're putting money into a 401k, look for what your company matching is. So if they'll match 3% or 5% of your income based on your putting in that much, you at least want to put in that much. If you can put in 10% or more, and again, depending on your age and a number of other factors as to what that number might look like, I find for many clients in that 10% plus range is a good target. Now, so depending on how much money you have to start, if it's in a 401k, they're going to give you investment options, and depending on those options, you want to elect ideally index funds if you can find those as a way. Again, the younger you are, that's another factor with regard to saving for retirement. The more time you have, you can put up with more volatility. So an S&P 500 index fund, for instance, does exceptionally well over the long term, but you're going to have to deal with a bit of a roller coaster, if you will, in between typically. All right, so it's not a dollar amount. Any dollar amount can get you started. The other part and what we do when we do planning, and with my book, it's the same thing. I get into showing you how to do these projections so you can see how much you're going to need to be able to save and how much you need to earn on your savings to be able to maintain your standard of living and quality of life. So that's a long answer to that, but any amount, Evelyn, will do. The most important thing is to start putting away money every month consistently and staying with that plan, staying disciplined with it.
Can I ask one more question?
Sure.
Say you're a person that has a small income, like Social Security.
Sure.
But then you have a little bit of money that you want to invest.
Right.
You don't work anymore, but you just want to, say you're getting money off of your house or whatever that you sell.
Okay.
Where would be a good place to put,
all right,
say, $25,000, and say you, in terms of interest, where's the best place to put it in terms of interest, return, and security?
Well, and there you go. And the key is the safety part. And this is one of the areas you mentioned, options as an example. You got to be very careful if you get into areas in investing, such as in options or future contracts and commodity, all the different more speculative type of investments. They look appealing and attractive. The problem is they can be also very risky, and therefore you don't want to lose money as well. Okay, and you have a greater risk of that. A well-diversified portfolio is going to be your best bet. The portfolios I work with, for instance, and I'll show you something here. These are, we call these true market portfolios, and this is something I can get you a brochure and information on if you want to check in on the office. But basically, what a true market portfolio, what we're looking at is about 15 to 16,000 different stocks or companies represented there. That's true diversification. Now, the next part is how much of your portfolio. So whether you had 25% in stocks, it's still going to be 15,000 of stocks in that 25%. The other 75% is going to be in short-term, high investment grade corporate and government bonds. So they're going to be pretty safe and stable, though they're not going to give you a lot of return. The equities are going to drive the return. So whether it's 25% in stocks, 50% in stocks, 75, whatever it is, that's going to increase volatility, also increase potential return. So depending, again, on what your overall goals are, whether you would need to be able to access those funds, whether they're in an IRA. So there's a lot of factors that go into determining what the best way to invest that would be. All right, so your situation is unique, and if you want to check with me at my office or send me an email, I can maybe get you some information that'll be more help for you in dealing with your specific situation, okay?
Okay, thanks so much.
All right, thanks, Evelyn.
Bye.
All right, we're going to take a quick break. When we come back, we're going to dive right into 18 scary retirement statistics and the strategies that you can use to help protect yourself against these very scary statistics that we're going to share with you. So join me here. We'll be right back on the Retirement Report.